We'll continue our conference now with the World Bank sponsor plenary session discussing emerging markets and the global economy, lessons from BRICS. Well, first of all, I have to excuse Mr. Alexandre Tobini, who was supposed to be the chairperson for this session, but I mean he had to go back to Brasilia tonight, actually, and he asked me to replace him. I'll try to do that, although I think that will not be as brilliant as he would, for sure. Well, let's start. To present our speakers. The first will be Justin Lin, Chief Economist for the World Bank. Then we will have sorry, I have to put my glasses. Abhijit Banerjee from MIT and Armínio Fraga from Gávea Investment. I think that, we had actually, the BRICS received a sort of heavy burden, right? In the last, let's say, in the last year or this year, right? When the decoupling thesis was alive, let's say. Apparently, things are a bit different at the moment, right? And probably that's what we're going to discuss in this session. Please, let's start with Justin.
Okay, thank you very much. Well, this year is the 30th anniversary of China's reform. And I'd like to use this opportunity to share with you my observation about China's achievement in the past 30 years. And everyone knows, if we want to choose a word to describe China's achievement, the only suitable word would be miracles. Because in the past 30 years, the average annual growth rate in China was 9.7%. Chinese economy experienced 12 times. And the trade growth rate was 15.4% per year, and the Chinese trade increased 120 times. And everyone knows now China's foreign reserve is 1.9 trillion US dollars. But in 1990s, China wanted to borrow 100 million from some international financial institution to help with its balance of payment issues. China was unable to get that. It's a remarkable achievement, but I have 3 questions to share with you. The first one, why only in these 30 years of reform China was able to have this achievement? And China had a revolution in 1949. And from 1949 to 1979, those 30 years, China did not have achievement at all. Why? And certainly you will say it's reform. But we know that many countries also engaged in the reform in the 1980s and the 1990s. But only China achieved this remarkable result, or to some extent, also Vietnam. While most other countries engaged in transition and reform, they did not have similar achievement. And the third question is that, can other countries in the development process, in the transition process, could have similar result as China achieved in the past 30 years? Time is short, so I cannot elaborate. But I'd like to say, theoretical point of view, every country should have that opportunities. Because if we want to look into a sustained growth in any country, the most important one is a continuous technological changes. We know that because we compare the economic performance before the Industrial Revolution and after the Industrial Revolution. We know that before that, the average annual income growth per person for 1,000 years was on average per year 0.05%. That means it takes 1,400 years to double per capita income. After Industrial Revolution, it accelerated to about 2% in the developed part of the world, like in Europe and in US. And that means 35 years of time, you can double your per capita income. Technological changes is the key. Industrial upgrading is the key. But after the 60s, we know, if a country knows how to take advantage of backwardness, then a low-income developing country could achieve about 8% or 9% annual growth rate. And that was the miracle of Japan, the miracle of East Asian economies, like Taiwan, Korea, Hong Kong, Singapore. And if you look into the performance of China in the past 30 years, it was the ability to utilize the advantage of backwardness and to pursue a continuous industrial upgrading, technological upgrading. But the issue why before the 1979 China was unable to tap into the potential, I think it was China, like many countries in the world in the 1950s, 1960s, they neglect one thing, that is technology and industrial structure. In a country, in effect, it's endogenous to its endowment structure. We know high-income country, they concentrate in capital-intensive, technological-intensive industry technologies. It's because they are capital-abundant country. And low-income country, they will have competitive advantages in sector of resources-intensive or labor-intensive industries. However, most countries in the 1950s, 1960s, including Brazil and many other Latin American countries, and in effect, almost all the developing countries, no matter it's in the socialist camp or non-socialist camp, they adopt some kind of import substitution strategy or heavy industry-oriented strategies when they were capital scarce economy. Try to develop into certain kind of industry which they don't have competitive advantages. And under the kind of situation, certainly all the firms in those priority sectors are not viable. Since they are not viable, so they need to have the protection from the government. And the way the government protects that is introduce all kind of distortion in trade, in finance, in labor sector, and so on. And with that, we know that you are going to create all kind of rent-seeking situation. You are going to suppress the incentive and so on. So that's the reason why China, as well as many Latin American countries, was unable to tap into the comparative advantages and as well as the advantage of backwardness to achieve a dynamic economic growth. And because of that, the economic performance in China before 1979, the reform, was very poor. And so starting in the 1979, China had this transition, had the reform. And again, many other countries in the 1980s, 1990s also had the transition and reform. And how come only China achieved this kind of remarkable growth rate and others, they experience a long period of transition, recession, and so on? I think, again, there are some indigeneity issue. It's forget. It's ignored. It's because for this transitional economy, certainly you have a lot of distortion, and that's very inefficient. But we know distortion itself is endogenous to the needs to protect the priority sector. You have a lot of firms are non-viable. They are there. And their survival rely on this kind of government distortion to protect them. And we know that in the 1990s and so on, when they try to do the reform, they only see the distortion, see its adverse effect on resource allocation, on incentive, and try to remove all those distortions immediately. And the result is that if you did not deal with the cause of the distortion, try to solve the issue of non-viability of those firms, and you try to remove the distortion, very likely you are going to change from the second-best situation to the third-best, fourth-best situation. That is the reason why I think many countries engaged in the transition, their performance was even worse than what they had. And so Bill Easterly called those 20 years as the lost decades. And China was able to achieve dynamic growth. Was first one, the Chinese government under the Deng Xiaoping's leadership improved the incentive in agricultural sectors and also in the industrial sectors by linking the effort to their reward. So incentive improved. But at the same time, China adopts certain kind of dual-track approach. That is, on the one hand, liberalize the sector which the China had comparative advantages, allow entry. At the same time, introduce certain kind of protection to the sector which China doesn't have comparative advantages. That was the priority sector in the past. By this way, China achieved stability and a dynamic economic simultaneously. And with the dynamic economic growth, more resources was created, capital was accumulated, then gradually find way to reform the sector which China does not have comparative advantage. So that's the reason why China can achieve this 30 years of dynamic growth during the transition periods. And with this understanding, I think every country has an opportunity to achieve similar dynamic growth as China achieved in the past 30 years. That is, in your policy making, you need to understand the endogeneity of your industrial structure, of your technology structure. And I try to create a condition for this kind of dynamic upgrading in your endowment structure in order to upgrade your industrial structure and technology structure. And if you are on a transition process, you need to recognize a lot of distortions are endogenous. And then you need to tackle the cause of the endogeneity. On the one hand, to provide the opportunity to get into the sector we have the dynamic, you have comparative advantage. But on the other hand, you need to be pragmatic. Try to, still provide some kind of protection, but create a condition gradually to get out of those kind of protection. And in order to provide a stability. And by doing that, I think two things are very important. The first one, certainly, you need to have a market institution, provide a competition, so the firm will know, they collect price signals, so they can get into the sectors that you have comparative advantage. But at the same time, I think you need to have a state. The state, I call them facilitating state. Because not going into the development process, for a developing country, it lag behind not only in the industrial technology to the advanced country. Its institutions also were backward, lag behind. And in the industrial upgrading process, there's a lot of coordination issue. For example, take the market transaction. For a poor country, a lot of transactions are within a village, among the people who know each other. But with the industrial upgrading, increase in the scale, you are going to move into exchanges which are arm's length. So under this kind of situation, you need to improve your legal structure and so on. And those kind of coordination cannot be internalized by firm. So you need to have a government to provide those kind of public goods. That's just one example. So you need to have a facilitating state for the development. And for the transition, certainly you need to have a state in order to know how to liberalize the sector, allow the entry into the sector which you have comparative advantages. At the same time, you need to have the government to design a policy to provide some kind of credible protection. At the same time, to remove the protection gradually. So if we can really recognize that, I think every country, including Brazil, will have the opportunity to achieve 9 or 10% growth rate continuously for another 20, 30, or even longer time. Thank you.
Thank you, Justin. Well, let's have now 15 minutes for India. Thank you.
Thank you for having me here. Is it working? So let me start. Some of you might recognize that Paul Krugman, but what's also, he has a crystal ball in front of him. And I think other than with a crystal ball, I think it's pretty dangerous. These are pretty dangerous times to talk about what's going to happen to the BRIC countries or any other country, given that we don't know what's happening to the world economy. So what I'm going to do is mostly tell you what I would call the strange, what I would call the strange history of India's economic growth. So I rather than talk about what will happen in the next year, or look into the immediate future, what I'll try to do is tell you, I think, my version of what happened in India, which isn't exactly the textbook version, you might, and try to discuss what the Indian pattern of growth says about the rest of the world. And I have a less optimistic conclusion than Justin's, but I'll come to that at the end. So what I would call the strange history of India's growth. Well, there's a very nice paper by Kalpana Kochar, Raghu Rajan, and a bunch of other people from the IMF. And one of the things that that paper says is that what was India was in the era of, let's say, just before liberalization. So say, think India in 1990, if you look at the data, what's special about India is really not a country at all that is particularly biased towards services. It's a economy that's biased towards, if anything, manufacturing. It has a bias towards high-skilled sectors. Within each sector, there's a bias towards high skills, and an extraordinary level of diversification. That is to say, India was, as Justin was explaining, India was extraordinarily distorted. They were producing everything and its mother, and so you had lots and lots and lots of goods that were being produced. India, by their estimate, was as diversified as an economy that was 20 times as rich. So this is the number they come up with. And then an extraordinary number of small firms. And I'll come back to the small firms if I have time. Another fact that they emphasize is what went with that was an incredible level of undercapitalization. So if you look at the Indian firms, the little blue things are Indian firms, and the purple things are this is the average size of an Indian firm relative to the average size of a firm in the same industry in other countries, including an average of Brazil, China, Malaysia, and Korea, and a few other countries. If you compare them, India had tiny firm size. Okay, so this just look the magnitude. The picture is good because it kind of gets you a sense of you're really talking about tiny here, 1/10 the size of the. So this was India. So I don't fully understand how this technology works yet. So the presumption, presumption was that all of this would go away as soon as India liberalizes and it becomes a normal economy, which all the world market prices. So in 1991, India liberalized, and then the tariffs came down massively, kind of in line with China. Became much more open. Likewise, there was this view that the Indian economy was too aggressively anti-monopoly, and that's why all these small firms were there, and that the labor laws were all distorted, etc. And that liberalization will fix everything. And what happened? What happened? And then growth would accelerate because all these good things will be done. And India was growing very slowly, but actually it wasn't growing that slowly. This was part of the story. But in fact, India, if you look at when growth accelerates about a decade before liberalization. And it stays accelerated at that level till about 2001 when it accelerates even further. But there is no trend break at liberalization. And this is a well-known fact. So nonetheless, there was some story that this will happen. What happened? what happened, again, according to these people, was that growth didn't change. Diversification went up. Remember, India was 20 times more diversified than it should be. It became 40 times as diversified. Bias towards high-skill sectors. Remember, India is a low-skill economy which is supposed to have lots of unskilled labor. Bias towards high-skilled went up throughout the process of liberalization. Service sector grew a lot and became more high-skilled, and firms remained tiny. So that's what happened after liberalization. So so now you have to sit and sort of parse that, if you like. So what I want to do in the next few minutes is offer an interpretation, and this is sort of it's not an entirely mainstream interpretation. If I were the almost vice president of the US, I would call it mavericky. Okay, so let me just set out by, so I'm going to tell you a story now. And this story, I'll then at the end draw out a few implications of the story. You don't, obviously it's a pretty extreme story and you may not believe it, but it's at least it'll be different from the standard narrative. So I think the key facts about India are that India massively overinvested in tertiary education in the pre-liberalization sector. This was period. This was the fact that people constantly criticized India, that this is a sign of elite capture, that is, India is not investing in tertiary education. They might have been right, for all I know. Now, this created a large number of well-trained people who were basically in this economy, which was essentially had very low productivity growth, were sitting there cooling their heels. Now, they were doing very little. So if you think of India from the period 1950 to 1980, they were training huge numbers of engineers who were doing not much. And they were cooling their heels in the public sector or producing import substitutes using primitive technologies. A lot of these people started looking for something to, what happened in the 80s that's key is that in the 80s, a lot of these people started looking for something to do that was different. So one of the most remarkable experiences I had was in mid-90s, I was studying the software industry in India, and I went to a software firm. I couldn't find it. I was directed to it, I couldn't find it. Turns out the firm was called British Airways HAL. And I couldn't find where this was. Now, HAL was the India's largest defense airplane manufacturer. So finally I found it. It was inside the India's largest defense airplane manufactory. There was a small firm that they set up, and what they were doing was they were a back office for British Airways. This was inside India's, cutting-edge technology fighter manufacturer. They were using the resources of that firm. These guys, they were overstaffed in engineers, and what they were doing was they were making low-quality software for British Airways. And as a result, these guys who were going into business, nobody had any capital except the state. So people who were going into business, especially all these engineers, they were all looking for niches. They don't have any capital, so they were all entering into niche products. Think of the diversification. They were all entering into specific niche products they were looking for. They were looking for opportunities. They were not looking for places where they could make big investments and benefit from scale. So then the period up to 1997, I sometimes call waste makes haste. This was a period when the remarkable thing about Indian, especially Indian software industry at that time, this is I think the leading industry in India, and in this period the industry that's growing fast. The remarkable thing about this industry is that because these guys were largely had no alternatives, they were pricing themselves at a level at which nobody imagined. So the reason why they penetrated the market was they were offering things which I don't think they had any sense of how low the prices were. I was once sitting in the office of one of the CEOs of one of the largest Indian firms now, and he went and talked on the phone to somebody for a little while, and he came back and said, I just doubled my price per line. And these guys didn't seem to mind. So I think I'm going to double it again. In other words, they were just so cheap. they were so inside the frontier that people were willing to experiment. I think the way to think about what happened in India in this period was India was producing actually lots of products that it was not supposed to be producing given its competitive advantage because of the mispricing of skilled labor. And these goods were extremely cheap. And as a result, people were very willing to experiment on India. So India benefited enormously in this period from a process of attracting people, merchandisers who come there to buy stuff and try out India. So India was getting into sectors where nobody would have given it a chance, largely because these things were being offered at way below, I think, any reasonable price. I think that's very important, that India's core competitive advantage got defined by a process of experimentation. So as a result, what India came into the next phase with was what I would call an enormous reputational capital. Lots of individual firms which had very little scale but lots of reputation, and that's this phase. So people were now willing to investigate the possibility that if they wanted something specific outsourced, they could go to India. The next stage, so GM started experimenting with car parts, GE started experimenting with doing research in India. GE in 1996 set up the biggest research lab they had anywhere outside the US in India suddenly. So in 1996, which is, so I think the willingness to take completely very brave decisions came from partly the pricing was very, very attractive. The second stage is that I think it was, and maybe I'm going to run out of time, so let me not go through all the stages and sort of tell my rest of my story quickly. The second stage, I think it's till about 2001, what happens in India is that this gets established, this process of reputational capital starts getting leveraged, lots and lots more people are willing to try India in specific niche products. So you wanted a product manufactured which was particular kind of specialized paper. You wanted to go and get somebody who's going to provide a high quality at a low price, you tried India. And I think this process was key to the fact that the competitive advantage in India was defined ex post by who experimented and who tried out specific production strategies in India. And that sort of, I think, defined India's competitive advantage. That's why one of the things we see in India is this massive diversification going up in liberalization, because new product lines are being introduced as the demand comes up in response to some merchandising coming into the country. So I think so this is a period where, and I think in this period it was a big advantage for India. I think two things I will say which are particularly, I think, not often emphasized. I think big advantage for India was that lots of people, and I know this part of this business relatively well, I know a lot of people involved in it. I think it was big advantage for India was that India was seen as a good country to visit. And so lots of people willing to come there, spend some time, visit one manufacturer, he doesn't do it, you go to a different one, and you find the guy. And I think that was a big advantage for India, an open country, you can go there, you can go anywhere you want, you can do what you want, and this was, it was seen as some place where people speak English. All of these things were valuable for India, that people could go find the supplier where they were looking for it. So I'll skip all this stuff. So then what happens after that is relatively, I think, more standard. What happens, well, even there, one nice fact is that what happened was that the dot-com bust did a huge favor to India. Under the dot-com bust, the Indian stock markets crashed. And because the Indian stock markets crashed and there was no interest in them, they implemented a massive set of reforms. We making, especially the National Stock Exchange, cutting edge in terms of a number of the standard attributes of efficient stock market. So Indian stock market quality went from being fairly low to very high very quickly because the market was dead. As a result, you got a lot of foreign institutional capital coming into India after 2002. And the next period, you start seeing an acceleration in growth. The reason why you see an acceleration in growth then is that suddenly scale starts going up. I was telling you these firms are tiny, scale starts going up. So the next phase, and then that phase so you see accelerating growth rates through the 2000s, and I think the main variable that's key there is the increase in scale of firms. That now there's diversification is actually starting to decline, and the scale is starting to go up. And you see that that's the phase that starts after 2001. So what does all of this say about where? So I think it's fairly clear that several things that this immediately implies. I'll just skip through these slides because I think I said most of them. I'll especially skip the now part of it because I'm frightened by it. So let me say one thing. So one thing that this implies is that if you think that what these firms that drove the growth of these firms in India was the reputation, then you'll see something that you don't usually expect, which is going down the technological. So these firms are operating in an economy which is essentially low. Skill supplies are scarce, so there's not a lot of skills. You are built a reputation for delivering high skills. Skills are scarce. What do? You want to expand scale. Well, instead of going up the skill ladder, you go down the skill ladder. So what's happening in India is India started with doing software. Now it does less and less software relative to other non-software high-tech industries, less high-tech. So India has moved from high-tech to less high-tech, and rather than the other way around. Most countries go up the skill, and that's because India's built reputation and then started exploiting the reputation. The place where you see that is in business process of outsourcing, which is sort of using 2 engineers to work with a bunch of semi-skilled people who can type in stuff. And this is where enormous part of the growth is going. I see India growing even further down in the skill ladder. I think what's going to happen is that there will be even more leveraging of management, even more leveraging of reputation. Few managers working with people with high school education who are trained to do something specific is going to be the sector where India will grow. And you'll see Indians are already setting up cell phone companies in many countries, hotel chains, retail. These are sectors where you don't need enormously high skilled people, but a few engineers and a reputation helps. So I think this is where you see expansion in India. I think the other thing that this implies is that Indian growth will continue to be jobless. That is to say, it's not going to be a growth where the unskilled laborers are going to find a lot of opportunities. This is a fact that's been remarked on, and I think this will continue. That says that what's one of the big dangers for a country like India is growing inequality, and growing inequality with, I think, a set of political pressures that come from democracy might actually generate sort of a populist crisis of some kind, familiar in Latin America in a sense. So I think that's one of the big dangers. So, and the other big danger is obviously skill running out. And the Indian government is not doing a great job of improving skills, and that's a big problem for India. India's biggest single problem probably is just the fact that skills are not being improved. So lessons from Indian growth. I don't know that if you believe my story, there are not that many lessons, right? This is not a story that says that you imitate this, get it all wrong, and somehow work your way out. Doesn't seem like a lesson. So hard to say that there's a lesson there. Now, one thing I do say is that what it says is there's something that I'm firmly convinced of, which is that in terms of our ability to predict growth, I think we are pretty bad. And I think if you look at all the things that India, or even the causal mechanism generating growth, India not only had made all the wrong choices then operated to create growth, while I think all the things that it should have done in some ways adjusted to make way for them. So in some ways it's hard for me to have what I would say is what I don't know and is what I would say. Let me just, slides are useless. Let me just I have a minute, and let me just finish in that minute. What I think is if you believe this story, then I think, and I think China is actually more like India than maybe. I mean, I tend to believe that even China has very much the same kind of advantage, which is reputational capital. One of the things it implies is that for many other countries which are like India and China, poor, low-skilled economies, at this point, growth is going to be very hard. I actually don't believe that the markets exist. I think anytime Bangladesh wants to compete, it has to compete with India and China. Anytime Nepal has to compete, it has to compete with India and China. If Ghana has to compete, it has to compete with I think these countries, one thing about reputation is that reputation makes things very sticky, because I want to go somewhere where I can trust that I'll get the good I want. I don't want to be fishing. And if I have a supplier which a big country can expand a lot, which can do the same thing, two big countries of the size of India and China, they are potentially blocking growth for many other countries like India and China. And I think this is, if you take my view seriously, then I would say that India and China are the constraint for many of the other, not for Brazil, which is a different, in a part of the skill distribution and different part of the endowment distribution, but I think countries like Ghana, like Nepal, like Bangladesh, actually India is part of the problem, China is part of the problem. So I'm less optimistic that this model can be replicated. In particular, I think that this model in some ways, in the long run, I assume that wages will rise in these countries and that will then re-equilibrate, but in the short run, I think this is part of the problem. So I'll stop.
Thank you, Abhijit. Thank you, Abhijit. Let's go straight to Armínio Fraga. You're good.
And this as well.
Have to take the mic as well. It's convenient.
Acho que não.
Okay, good evening. So I'm going to cover Brazil. Also, not quite an optimistic view, but I guess in our case, looking up a bit. And it's a hard act to follow, Abhijit, so I'll just try to do it quickly. So first thing, just a little bit of background. This is a BRICS session. Russia is missing. Russia is still on a per capita basis, PPP per capita basis, the one that's higher up. I showed this just to make sure we remember that Brazil did have some good years, and in fact, if you look at the first 80 years of the 20th century, Brazil was the second fastest growing country, second only to Japan. More recently, however, we've had some problems. And the story kind of goes as follows. Say, up until 1980 or so, we had a wonderful run. You can see there a piece of it. If you had gone back to 1950, it shows a similar pattern. These were years of industrialization, so sort of moving people from agriculture to industry. And then this phase that I picture here was a phase more focused on infrastructure. This model was one of a closed economy, very big government presence in not only in regulating things, but also actually doing things. I think for a long time, the government was probably responsible for about half of GDP. It was also an economic model that was very prone to macroeconomic crisis. It was very unstable. A number of crises over the years, particularly as we started sort of some years of frustration in terms of growth. So the more frustrated we got, the harder we tried to do what wasn't doable, and the more trouble we got into. So we had hyperinflation a couple times. We had quite a number of debt defaults. This was an economy or a country that was not focusing on education, and it really wasn't focusing on efficiency. So that's sort of big picture. I'm also trying to do it reasonably quickly. I guess I'm standing between you and dinner. So then came the next decade, or the next 12 years or so. These were known here locally as sort of the lost decade. They actually lasted a little longer than that. And we averaged, I don't know, 1 or 2% growth or so. We had 0 or negative per capita growth during these 12 years. During this time, we were basically trying to stabilize the economy and just kind of thinking about how to fix things, but it was very difficult, really, from a political economy standpoint. The winners in the previous cycle, as you know, they tend to stick their roots in the ground, and it was hard to change. In many ways, we had this sort of nostalgia about those years of fast growth, and the question that is still being asked, by the way, is why can't we go back to the way it was then? A byproduct of this, I don't have a picture on it, is it's in many ways the income distribution we have that is a very unequal one, a very bad one. It was sort of not an accident. It was part of this model that I described. Right around the early 90s, things started to change. We started to open up. I don't quite go back to 1990. I apologize, but you can see, you get the hang of it. The opening also, hello? Dead. Maybe ran out of battery, it's too far, I don't know. I'll keep talking, you can try to fix it. Posso ficar? Posso. Abhijit, may I switch? This must not be Indian technology. So we also got quite a bit of foreign direct investment. We changed our constitution to make it so that foreign investors were treated equally with foreign investors. I guess we were second to India in this phase that we're still going through. It's been a good experience, not just for folks like us, but if you ask person out in the street, they'll be happy to work for a foreign company, happy to learn and so on. Then we had stabilization. I do have a chart. That was inflation, little skinny. So I have another one that's more recent, but you just saw it. Mario, who's sitting here, gave you the recent inflation rates, but that's the kind of thing we had. After a number of failed attempts during this kind of double peaked history here, we finally got it. And that's what we have now. You heard it from Mario before, those of you who were here. So we have now a system of inflation targeting, floating exchange rates, and prudent fiscal policy. And that has been in place for about a decade. So that worked out well. We had banking reform along the way. We found out after inflation disappeared that our banking system was very fat. So we had a banking crisis. It happened at a reasonably good time. It was well managed. Have a healthy banking system. This is inflation more recently. And we had this fiscal adjustment that was alluded to here in the previous panel. And there are also quite a few microeconomic reforms along the way, not all. We had a successful privatization program, all kinds of credit reforms. Bankruptcy law was changed. We introduced a wonderful listing in our stock exchange called the Novo Mercado, the new market, with really superb governance standards, very nice self-selection mechanism. And as a result, we've seen, well, I'm back to the one, so the low years, we've seen since then a bit more growth. But really, truth be told, it's been a little frustrating. We haven't seen that much growth. Towards the end, we were sort of getting close to 5%, but we have to factor in these incredible bull years of 2003 to 2007. So, you know, we're maybe growing at around 4, if you will, at this point. Nothing to write home about, but a lot better than the, say, 2% that we had during the last decade. We do have quite a few problems in the usual sense. These are opportunities and challenges. I would say at the top of the list is the quality of our education. We have managed to put most of our kids in school, but they don't really get a very good education. So that is a problem. We have a major infrastructure gap that is, I think, in many ways a reflection of all kinds of problems we still have with our regulatory environment. And we rank very low in the World Bank doing business surveys. And I think I think we're 125th. Maybe we're not that bad, but it doesn't feel that bad actually being here. I'm in business here. I started my business 5 years ago, 5.5 years ago after I left the central bank. But at any rate, this is not a simple country to operate on. We have still a weak fiscal regime, even though we have been delivering a primary surplus every year since 1999, and a slightly growing one, as a matter of fact. That has happened while government expenditures kept on growing, and we're approaching 40% of GDP. For a middle-income country, this is very, very high. In order to deliver the primary surplus that we have, of course, we had to increase taxation, so the tax burden for the 3 spheres of government is, that one is approaching 40%. So that's a problem. We also have, not only are government expenditures very large, we also have a bad mix. We have lots of current expenditures and really not much investment takes place. It's only at 3 or 4 percentage points of GDP. That also needs to change. We have had high interest rates. They're declining slowly, but they're still quite high, so the cost of capital is high. And as a result of the things I just mentioned, the investment rate also is quite low. And so there are some important challenges ahead of us. Some are easier to fix than others. We're going to have to reform our Social Security systems, things like that. Now, on the positive side, there are some good things, and I want to end on a more positive note. As I was saying before, our macroeconomic regime is more robust. It's been through some pretty impressive tests, particularly the transition period from 2002 to 2003, where most people, including most of us here in Brazil, thought we were going to go into a major crisis, and luckily, the new government turned out to be quite pragmatic, quite prudent, and did a very good job. And that, I think, really lowered the perception of risk about Brazil. We've seen this in other countries. I think you had that in Chile in the transition from military rule to democracy. There was quite a lot of fear, and when the new government came in and it actually improved on what the military government was doing, things, Chile's investment rate actually jumped up at that point. And it kind of happened a little bit like that for us. Our government has a fairly clean balance sheet over the years. The government's debt has been de-dollarized, and we've accumulated quite a good cushion of reserves. On the political side of things, we are a very open society, and this is something where we differ from say, China. As always is the case, there are a lot of issues around this, but I do think in terms of political stability, we're high up there. It is a wild, open democracy with a very strong press, a very free press, And I do think this helps us kind of navigate through quite a few challenges. We have seen, and here I have a chart for you, an important gains as far as poverty is concerned. You see a substantial decline in the poverty rate here in Brazil. I don't have one here, but we also have, I think we're one of the very, very few countries in the world that has seen in the last decade or so an improvement in the distribution of income as well. And so it's a slight but meaningful improvement in the Gini coefficient. And last but not least, we are becoming, oh wait, I have one more thing. That's on education. I was meant to have this out of order. So you see where we rank in these PISA tests. And last but not least, we are becoming more capitalist, more entrepreneurial, and I think this is also catching on. We had a nice bull run along with everyone else until about a year and so ago, and this really caught the attention of local entrepreneurs that really forever never had access to capital. They figured out that if they set up their businesses reasonably well with good governance, that they could attract capital. And this has been a phenomenal change. As a result, we now see sort of a food chain. You have below companies that can go public. You have sort of private equity type companies, and even now venture capital is becoming a reality. So anyway, just to summarize our story, our lessons, I guess the main lesson in our case is it is difficult to change. I do believe this sort of stickiness that Professor Banerjee mentioned applies to a lot of things. And in our case, it applied to us really having the wrong model, a very unstable situation. It was extremely hard for us to change. I do think, however, many of the lessons have been learned. We have tried everything you can imagine as far as macroeconomic policy is concerned. If any of you ever need advice on how things work, and particularly on how they don't work, come to us. But the fact is, I think we're now very mindful of the risks, of the costs, the social costs of macro instability, and we've done a lot of work there. And I think now the next stage is to work on the efficiency frontier. And I think that's sort of the challenge that we're facing. And you know, so far so good. We're taking baby steps, but in the right direction. I won't go into more current events. I'll do a little advanced PR. There'll be a panel tomorrow that will deal with this in Latin America. So I'll save my my short-term stuff for tomorrow. Anyway, thanks for your attention.
Thank you, Armínio. Unfortunately, we are run out of time. It's 8:10 already. I mean, we have to leave. We have no time for more questions, but I'm sure that as speakers we can talk to you outside. Thank you.